The Ultimate Trading Strategies Masterclass. So at the end of this masterclass, you will know, trading in a nutshell, what, why, how, when. 2 ways you can make money trading, how to make money in a falling market, the best chart type and how it works, top trading markets, trends, times, levels, and outcomes, and the most important, 5 best trading strategies. So the moving averages, crossovers, and swing, RSI analysis, overbought, oversold, market environment, and bullish and bearish divergences, 24 candlestick charting formations revealed, range-bounded trading, 24 powerful breakout patterns explained, and so much more. So before we begin, I need you to know that I'm going to go through the basics very quickly. This is an ultimate masterclass so that from the ultimate beginner can actually understand up until the part where we'd start doing more intermediate to advanced tips. And the focus is around the 5 best trading strategies. So make sure you stick around because these are strategies I have briefly revealed, but not to the extent that I will be doing it today. It's the first time that I'm actually revealing these strategies. And best of all, I'm so happy that you're with us today to enjoy. Masterclass Lesson 1. What is trading? Trading in a nutshell. Financial trading is buying or going long and selling or going short different markets to make bets for financial gain on short-term price moves. So you either buy or go long, where you anticipate that the price will move up, where you will bank a profit at a higher price and realize a gain. Or vice versa, you can sell or go short, where you expect the price of the market to drop, where you will buy back the derivative CFDs, whatever you're buying back at a low price and realize a gain. So that is trading. It is making a simple bet. But more importantly, financial trading is one big auction. There is demand, there is supply. When there is a lot of demand, there is buying. When there's a lot of supply, there is selling. And because human psychology will never change is the reason why financial trading inevitably will be the same. There will be trends, the markets will move up, will move down, and will move sideways, which means that when the markets trend, we have the perfect opportunity to follow the trends and profit at the same time. Masterclass Lesson 2. There are 2 ways to make money trading. So the first way is to buy low and to sell high. So you buy a price at a low level, you wait for the market to move up, where you'll bank at a higher level for hopefully a profit. Or you will sell high or go short, where you anticipate that the market price will drop, where you will buy it back at a low price for a profit. I'm building this up to information that I've never revealed with all the trading strategies that you've been wanting to know so bad, with high intensive explanations on how the strategies work. Masterclass Lesson 3. Make money in a falling market. What is short selling? Short selling is where you sell or go short an underlying market at a high price and then anticipate a drop in price, where you'll buy it back at a low price for a profit. And here is how it works. So we're going to use a South African company called BHP Billiton Group, or BHG for the ticker. And the share price was at 453 Rand and 49 cents. We expected the price to drop to 410 Rand. This is a trade we sent out to Premium Multi-Trader Service. So with short selling, you bet down. I expect that the market price will drop. And because we've had a bit of a bear market lately, with the US entering into a recession with inflation rates of over 9.1%, which is the highest rate since 20 years ago, because we have interest rates that are increasing, there is a looming idea that the market is going to continue to drop and there is going to be a bear market from here. So here's how it works. So you're going to short it at a certain price. You're going to expect the price to drop. So the short sell entry price is 453 Rand and 49 cents. The market then does drop to around 410 Rand and hits our take profits. And between where we shorted or sold and where we bought back is where we make a profit or a gain. Let's look. So there is a market maker, which is a company, a broker, and there is a short seller, which is you. So with derivatives and with trading, it's between you and the market maker, or between the market maker and you. You're not buying and selling to some other guy who's in his basement buying and selling shares. You're actually betting against the market maker each time. So it's almost like the casino. So you sell or go short 20 BHG CFDs at 45 Rand and 34 cents per CFD, and you are exposed to 9,069 Rand 80 cents. Just so you know, this is a South African currency. So you are exposed to 9,069 Rand 80 cents when you buy 20 CFDs, where 45 Rand 34 cents per CFD will give you exposure to one BHP Billiton Group share. All right. So let me say that again. The share price is at 453 Rand and 49 cents. And the CFD is you will pay 45 Rand and 34 cents to be exposed to the share. And you're buying 20 CFDs, which means that you will gain exposure to 9,069 Rand and 80 cents worth of BHP Billiton shares. Then the share price drops. So you sold or went short at 453 Rand and 49 cents. The share price drops to 410 Rand. And that's where you buy back the 20 CFDs at 41 Rand per CFD this time. So it's less, which has a new exposure of 8,200 Rand. You return the 20 exposed shares to the broker or market maker, and you bank the difference of 869 Rand and 80 cents. So you're basically taking the old exposure, which is 9,069 Rand 80 cents, minus 8,200 Rand, and you bank the difference, which is 869 Rand and 80 cents. When you sell or go short at a high price, for example, BHP Billiton Group, you are borrowing shares from the broker. Then once you've borrowed the shares and the share price drops, then you've got to buy back the shares to make your position neutral. And because you're buying it back at a cheaper price, you are banking the difference, which will give you a profit. All right, so that's how short selling works. In order to determine where a market's price is more likely to go, traders use charts through technical analysis. Masterclass lesson 4, the best trading chart to use. Let's start with how a basic line chart works and then head over to candlesticks. So here's a price chart, which is a line chart. And as you know, each chart has a vertical price, which is the price of the market or financial market, and the horizontal part of the chart, which is the time. So it can be a tick, can be a second, can be a minute, 30 minutes, hourly, 4 hour, daily, weekly, monthly, yearly, whatever time frame you choose or time period, that is what it will show on the horizontal time. And the vertical price is what prices will show at the time of buying a market, the close price, open price, the low price, the last price, whatever you choose. And what happens in between is the movement of where us traders make or identify and distinguish chart patterns, indicators, certain movements, and we make probability predictions on where it's more likely to go. And that's when we place a bet for buying or selling. So the market can move up, can move down, and can move sideways. But I have a problem with the line chart, and that it fails to show the entire market activity, which is the buying and selling prices during the chosen time period. So the solution is candlesticks. Each candlestick has an open, which is the first traded price for the time period, has a closing price, final traded price for the time period, has a high price, which is the highest traded price for the time period, a low price, which is the lowest trading price for the time period. It also has a body, which is a thick part between the open and close of the candle. And then it has a wick, which is the thin part between the open, close, high, and low. So each candle has a wick in general, and same with trading chart candlesticks, the wick is also the thin part of a candle, where it does not constitute of the body. Masterclass lesson 5, 3 types of candlesticks. So you have the up candle, the down candle, and the doji. The up candle is basically where the open price, which is at the bottom of the candle, is lower than the closing price. And between the open and closing price is the body. There is also the wick between the open price and the low, and there is a wick between the closing price and the high. And what tells you that the market is moving up is the color. So because I choose green, some people choose blue, others choose white, others choose red. I don't know why, but anyway, I choose green because I think of, in the money, dollar. The up candle has a body, in my case, of green, which tells us that the market is moving up. Then we have the down candle, where the open price is higher than the closing price. The body is in between the open price and the closing price. And because I choose red, it means that it's a down candle where the candle closed at a low price and where it opened at. Then there is a wick, which is in between the open price and the high price, and between the closing price and the low price. And then finally, we have a doji. A doji is where the open price is equal to the closing price. There is no body. Then there are the candlestick patterns, which we will go through later. Masterclass lesson 6, top markets you can trade. So what markets can you trade? The first ones is that you can trade equities, which is also known as stocks or shares, and you can trade local and international shares. Then you can trade indices, which is, for example, the All-Share JSE Top 40 Index, the S&P 500, the DAX, the CAC, the ASX for Australia. Then we have currencies, which is Forex, where you can trade the euro, the dollar, the pound, the yen. You can trade major currencies, minor currencies, exotic currencies. You can also trade commodities, oil, gold, coffee, platinum. You can trade different cryptocurrencies as a financial market, Bitcoin, Dash, Litecoin. You can trade Bitcoin Cash. You can trade Ethereum. Masterclass lesson 7, 3 top market trends. So as we've mentioned before, there are 3 types of trend lines. There is an uptrend, which has a support line where a line is drawn from the low prices of the chart. It has a positive slope. There are higher low prices using both the body and the wicks of the candle. So a lot of people ask me, where do you put the trend line? Do you put it at the bottom of the wick, the open price of the candles in an uptrend? And to answer that, I always say both, because sometimes the wick is a bit of an anomaly, and you wouldn't be able to put the trend line because one little wick decided to trade all the way at the bottom, which interfered with it. So I always take the bulk of the movement between the open price of the candle and the wicks, and I choose the majority of where it's trading at to create some type of regression uptrend line. So in this case, we use higher low prices. And finally, it is connected with at least 3 low points. So the more price touches, the more valid it is. With an uptrend, I always make sure that it's established after 3 low points. The market is more likely in an uptrend, and I will follow the market than go against it. Then we have the downtrend line, which we'll be using a resistance line. A resistance line is a line drawn from the high prices of the chart. There is a negative slope where the market is clearly moving on a downtrend. There are lower high prices using both the body and the wicks of the candles. So once again, you're using the wicks and the parts of the body of the candle to establish the downtrend line. And this at the top is known as a resistance line, or what I call a ceiling level to those who have just started trading. And then it's connected with at least 3 high points. The more price touches, the more valid it is. Then we have a sideways trend line. The most important thing is that there are same level of low prices and same level of highs horizontally. When it comes to sideways trend lines, make sure that the trend line is horizontal rather than diagonal, because one price that the market keeps hitting is always stronger than a trend line that is diagonal and it is hitting more levels than one. A sideways trend line also has a horizontal slope. There are parallel horizontal lines forming a rectangle using both the body and the wicks of the candle. Masterclass lesson 8, the 3 trading levels. So with trading, there are 3 main trading levels that you need to watch out for. The first one is the entry level. What price are you getting in? What price are you buying the market or going long? What price are you selling the market or going short? In this case, we are buying, going long, as we know that the market is moving up. Second is the stop loss level. Now, stop loss level is pretty much a level or an instruction to the market maker or broker that tells the market maker that if the market turns against you and the prices hits this level, it will get you out because it's going against your trading strategy. However, you can still make profits with a stop loss level. And I do this very often with the Premium Multi-Trader service. The market moves up in my favor, and because it is continuing up on a trend line, I move the stop loss up so that if the market turns against us, we bank a profit. And I do this at least once or twice a month where we lock in profits. And then we have the take profit level, which is instruction to the market maker to get you out of the trade and realize a profit or a gain because the market has moved in your favor rather than against you. So you have the entry level, the stop loss level, and you have the take profit level. Masterclass lesson 9, when you can close your trade. When can you close your trade? First thing, during market hours. So especially with shares, stocks that are local and international, you need to see when the stock exchange opens and when it closes. So with South Africa, it's between 9 a.m. to 5 p.m. for underlying shares. For America, it's 3:30 p.m. to 10:30 p.m. for underlying shares. This depends on daylight savings. Sometimes it's 3:30, other times it's 4:30. It's whenever the clocks change. And then in the UK, it's usually the same time as South Africa, but also make sure that you watch out for daylight savings. Forex, indices, and commodities is a 24 hours a day, 5-day a week spot market, which you can trade. And then cryptocurrencies is a 24 hours a day, 7 days a week spot market, but you do need to confirm with your broker. Masterclass lesson 10, the 5 trading outcomes. Now, there are 5 trading outcomes that you can take with any one trade. The first one is that you can break even, where you do not lose any money or you gain any money. The second one is where you take a small loss in the market when the market moves against you and hits your stop loss. There is a small gain when the market moves for your favor and you bank a small gain. Then you have a big loss where the market either drops past your stop loss, it gaps, you bank a huge loss because you put too much money in. This is a position that you never want to be for a trader. You never want to take a big loss, and you should never expect this in your trading strategy. If you can see that there is a gap in your trading strategy that you can take a big loss, you are then trading incorrectly and you're trading based on greed and fear, and you just want to make the money as quick as possible. Do not ever settle for a big loss. And the only time you should ever take a big loss is if the market does gap and hits past your stop loss and gets you out at a bigger loss than what you expected. But keep following your trading strategy. And then you have a big gain, which is what we need to grow our portfolio to all-time highs. These small gains do keep consistent with making the portfolio trade a little bit up and a little bit down because you're taking small gains and small losses. But when the market does enter into a highly tradable and good environment for trading, these big gains, which does come at least 4 to 6 months a year, is what is going to grow your portfolio, which is why you need to take every single trade that lines up according to your strategy and not base your decisions on your gut, your opinions, what your mom said, what your dog said, what Jim Cramer says. You've got to just follow your strategy and just depend on it, because it's the only thing that you know has a high probability of it working out. So these big gains is what we look out for, and which is why we do not stop trading. Masterclass lesson 11, know your time frames. A time frame shows you the buying and selling prices or market activity during a selected period. So a time frame shows you the buying and selling prices during a selected period. You can choose to view time frames or periods from tick, seconds, minutes, hours, days, weeks, months, and even years. You choose your time frame based on your strategy. From my experience and from my personality, I like to trade shares and stocks using a daily time frame. With Forex, I like to use a 4-hour time frame and daily. However, when it comes to minutes, seconds, and ticks, it's not in my personality to take every trade that comes my way, because the more trades you take, the more losses that will incur. So a daily time frame is where we can take one candle, for example. So let's say that there is a candle that opens at 500 cents at 9 a.m. when the stock market opens. Then the prices move down to a low price of 495 cents, and the price moves up. So there's trading activity or market activity that moves all the way up to a high price of 525 cents. And then it closes at about 520 cents. Okay, so between the open and close formed the body, remember. Between the open and low formed the wick, and between the close and the high formed another wick. And between the entire day time frame or time period, there was a 30 cents range. The daily candle formed, and then what happens the next day, 9 a.m.? The new candle formed with a new open price. So the next day, a new candle will open at a certain level next to the previous candle on the right. It will then form the market activity that will take place to determine what candle forms. So in this case, it is a down candle. And at the end of the day, when it closes, then we will know that it was a down candle, the market is turning down, and it has a higher chance at continuing down tomorrow because supply is outweighing demand. A 5-minute candlestick chart looks almost identical to an hourly candlestick chart and identical to a daily candlestick chart. The only difference, or the main differences, with a 5-minute, the range will be a lot smaller with prices that traded between the low and the high, because after 5 minutes, a new candle forms. There are many 5-minute candles inside a daily candle, which means that the range will basically make up for many of these 5-minute candles within a day to form one candle. So the range is vastly different when it comes to time frames. Here's an example with a market. So Kellogg Co. 1-minute chart. You can see that this is an unattractive chart. We are not establishing good trends. There's not good market activity. And these are charts that I avoid by all means, because you can see that in many cases, there was no trading activity within the minutes. And also, what do you do with this? You know, there are so many gaps. So a gap is basically where prices do not trade between the low and the highs of the candles. There's gaps here. And you can easily, for example, the market's going up, you get in going long, and then the market comes down. Then the market goes up, you go long again, the market comes down. So it's very difficult to trade these low time frames. I do know people that do trade these time frames, and they are taking around 50 trades a day. I know some traders that are trading 500 trades a day. They break their keyboards. They throw their mouses across the room. They go crazy. So the question is, do you want to live like that? Probably not. You want to live a more stress-free life, risk-averse. And so these timeframes I avoid. 1 minute all the way up to 1 hour, I kind of avoid. So the reason why is because when you have lower time frame charts, there are more candles to deal with. there are a lot more short-term trends, and there are more trading setups, which means that there are a high number of winners and losers within your portfolio within one day. Now let's look at a daily chart of Kellogg Co. And you can see that it looks a lot more tradable and easier to handle. There are medium-term trends, which we can take advantage of. There are less trading setups, as there are less number of winners and losers. And you only need to worry about analyzing charts once per night, where you can end up taking 1 or 2 trades per week. After a number of days, you'll see something like this. A candlestick chart forms, depending on whatever time frame you choose, and you will see that there is market activity. But what you need to understand is that there is a lot going on between these candlesticks, which is what we're going to go through today on how to determine the momentum of candlesticks. With your chosen markets, you'll need to have a trading strategy to follow in order to make high probability calls on where to buy and sell different positions. So 5 best trading strategies. What is a trading strategy? A trading strategy is a method in the financial markets that bases predefined rules and criteria to spot high probability trades and make other calculated trading decisions. So these are the trading strategies that we are going to go through today, and we're going to go through it in a lot of detail. Right. So do you use leverage? Absolutely. Trading is all about leverage. When you are trading shares, you are having the full exposure of shares, and you got to put in a lot more money to bank a lot less with short-term movements. With leverage, you obviously put in less money into trades. You expect the price to move up maybe 2-3%, and you can bank 30 up to 100 to 200% of the margin that you put in with each trade. So if you put in 30 Rand and you bank 100% gain, then you bank 60 Rand. But that 30 Rand is not 30 Rand portfolio. It's 30 Rand of what you're willing to put in based on your portfolio. That is only based on the initial margin or the initial deposit that you put in with your trade. So yes, leverage is very important with trading. I can't think of doing it anywhere else, unless if you become like a medium-term investor, you look at the charts, you follow a weekly time frame, and then you buy local and international stocks. Absolutely. Then you can go with it, and it's actually a good strategy. The investing trader. What is a tick? A tick is the smallest increment movement that a market can move when buying and selling. So instead of looking at a minute chart where there's buying and selling within a minute, each tick is where there is a price. And when someone buys at a certain price, the next price that someone buys or sells will be the next tick. And that's what you were seeing. If you go to a tick chart, you'll just see there is no body in candlesticks because there is only one transaction per tick. To determine the trend, is a line chart better than candlesticks? Yes. Candlesticks basically shows you the activity within a certain time period, and trend line will show you the trends that the market is moving with those candlesticks. So as I showed you before, what we do as traders is we do nothing other than turn the chaos into order. And we do that through confirmation bias, where we are basically putting our own imaginary trend lines and saying that the market's moving up and therefore I'm going to follow it. And I'm going to use this line with the candlesticks to determine the trend. However, a candlestick, depending on what candlestick has established, can give you an indication on whether the trend is changing. The gap in candlesticks open lower or higher than the previous close between days. Why and how is it caused? When trading CFDs, do we need to be concerned with this? Good question. Let's get our whiteboard. So let's say the candlestick opens at a price. The market moves up, the market moves down, and then closes at a certain level. And then the next candlestick opens at this price, and the market moves up, moves down, and closes. The part where there was no trading activity is what is known as a gap. So what are the reasons that there can be a gap? One, the stock market opens below or above previous candles movement. So this is a time issue. If something bad happened overnight with the markets and all the markets crashed in the Asian markets or the Australian markets, and then the South African market opens the next day, it has a higher chance at opening because of the futures at a way lower price than what it closed at. So that is one reason for a gap. The second reason is that there can be major buying or selling volume with one market. So if there is a certain price that the market's trading at, and then there is a huge seller at another price, and they are willing to sell at a certain price lower than what it was trading at before, there is a good chance that the market will gap. And this is sometimes due to manipulation, or that there is volume being transferred from banks to banks or billionaires to billionaires. So that's another reason. The other reason for a gap would be if there is no liquidity. If there is not a lot of trading activity, and you would see this with penny stocks, go to any penny stock there is on the JSE market and go look at maybe a majority of penny cryptos, what I call them, or penny stocks, and go look, and you'll see that there is very little liquidity, which means that there is not much buying and selling activity taking place, which is causing those gaps in the market. And you need a lot of liquidity and a lot of volume in order to make up for those gaps. All right. How do you establish the best trading strategy? There are many ways to do this, but the most important thing is to first determine what is your risk profile. How much are you willing to risk per trade? How much are you willing to risk overall with your portfolio over a certain amount of time? And then the second thing is your trading personality as to what do you want to see in front of your eyes? Do you want to follow a trending market? Or do you want to be the opposite and say, I only want to buy at the lowest price and then let the market reverse to turn up, or sell at the highest price and make sure that the market price is going to drop? Then you want to be a reversal trader. Do you want to be a continuation trader where you're following the trend? Do you want to be a range bound trader where you don't care about a trend, you just want to grab the lows and the highs within a sideways consolidation area? You need to go through these type of strategies. And what we're going to do now when we go through these 5 best trading strategies is that you're going to ask yourself and say, do I like the strategy? I love chart patterns, but I'm not going to force everybody to like chart patterns. It all depends on you. So we're going to go through these 5 trading strategies and see which one resonates with you. And then when you have the trading strategy that resonates with you, keep at it. Patient. You need patience. You need passion. You need perseverance. You need persistence. And what else do you need? Pizza. I don't know. So make sure you find out what suits you as a trader. How can you make a profit with a 16% win rate? Very easy. A 16% win rate, you can make a profit as long as your risk to reward is above 1 to 5. So let's say your entry level is here and your stop loss level is here, and then 5 times up, the take profit is up here. So take profit, entry, and stop loss. And if this is more than 1 to 5, which means that I'm willing to risk 1 to make 5. If you do this over a number of periods of trades, you will find that even with a 70% win rate, you can be profitable. If you follow a risk to reward of 1 to 2, then you need your win rate to be over 40%. If you want a risk to reward of 1 to 1, then you need a win rate of over 50%. So that's generally how it works, and why the win rate is actually a myth. Whether you want an 80% win rate or 90% or 20%, you can make profit overall. But once again, it's down to your personality, because I personally don't want a 17% win rate. It's probably an ego issue that I have. And you can send in the chat and say, I agree, I don't want to lose over 50, 60% of the time. Right. What are the best trade times for the day, less volatility? This depends on the market. If you're trading shares, for example, the best times of trading in the day is probably an hour or 2 hours once it's established the chaos that's taken place, making up for the previous night's movements in other markets, the Asian markets, the Australian markets. So 2 hours after the market opens is probably the best time to start trading. And then basically it depends on the volatility of the market that you're trading, because some shares have different personalities to other shares. And for example, Forex, they generally move more or less the same type of range, except hours of when the stock market closes. So when the UK stock exchange closes, that is probably not the best time to trade the pound. You will see that there is a lot less activity taking place, regardless of the fact that the liquidity is so high and the volume is still high. You'll see that at night, the pound is not the best thing to trade. So it depends on the market. Cryptocurrencies, there are kids in the basements trading all the time. It's not really based on anything physical, and it's more based on future applications and future trends of what's going on in technology, AI, Web 3.0. So crypto, you can trade pretty much anytime and anywhere, but we're seeing a lot of volatility in crypto at the moment. We had a massive crypto winter. I've had friends that have lost $100 million just on one crypto. So it's scary of what's going on. I'm long at the moment with Ethereum, with the premium multi-trader service, quite happy to be long. But as you know, I do not risk a lot. I do not have a lot of greed with these type of trades. If I'm wrong, I'm wrong. If I'm right, I'm right. Do you trade synthetic indexes like volatility? I used to trade synthetic indexes like volatility, but then I realized that the trade numbers that would come out were so few that it did not make up for my trading journal and whether it works or not. So I would get a signal once every 4 to 6 months. And now I use those indexes to determine or to give an idea of where the markets are more likely to head in the future. And then with those indexes, I then go look at the markets that are in the basket, and I determine the trades that I'll be taking. How much leverage? Leverage depends on the market maker. It depends on your broker. Forex, there's sometimes trading leverage of 100 to 500 times, which means that what you put in, you get exposed to 100 to 500 times more. Whereas shares, you put in a little bit of money and you can be exposed to 6 times that amount or 10 times that amount. And then we have, for example, commodities where the leverage is 20 to 50 times. But you need to hold over 100 contracts in order to be exposed to one of them. So it all depends on the markets, really. And win rate, yes, that is good. I hate losing. If you're only winning, you know that your losses are there to come. So sometimes when I'm in a winning streak of 7 to 10 winning trades in a row, there is that imbalance, though, of when you're winning, and you kind of want to lose to bring back the balance with your trading strategy. Because what if you take even 20 winning trades in a row, and then the next bunch of trades is like 20 losing trades in a row? That balance of having losing trades in your trading strategy that you follow makes it feel more realistic in what you're trying to build. To lose is to win. To fail is to succeed. The only time that you truly fail is when you quit and when you risk a lot of money. So don't be afraid of losing. Embrace your losses, because it means that you are on the right track. I hope that helps. I really hope that helps. Okay. Question and answer time's over. Let's get to the trading strategies. The 5 best trading strategies. So we're going to go through moving average, swing, crossovers, RSI analysis, price action, 24 candlesticks, range bounded trading, breakout, 24 breakout patterns. Masterclass lesson 12, moving average, swing, crossovers. So we're going to talk about the trading strategy now. So here's an example of how the moving averages crossovers work. What is a moving average? A moving average is a curving trend line which shows you average prices of a market over a specific period of time. We use moving averages to help identify the past, current, and potentially future trends. Wait a second. What did he just say? So let's go back and let's break it down very slowly. A moving average, so it's these squiggly lines, is a curving trend line, which shows you the average prices. So each point of these moving average shows you the average prices of a market. So it can be any market, stocks, indices, commodities, Forex, crypto, over a specific period of time. So this is a time frame that we chose. We'll say daily, and it basically makes up the average prices over a certain amount of days. We're going to use simple moving averages. And the reason is because I understand it better. If you overlay simple moving average and exponential moving average on a chart, you'll pretty much see they are quite similar. And so I'd rather use simple moving average because I want to understand what I'm doing. So let's use a 7 moving average as an example. So 7 moving average is basically where you take the closing prices of 7 prices and you divide it by the number of periods that you are looking at. So you would divide it by 7. So 7 prices, you know, if it's trading at 179, 180, 182, 184, whatever, you add up those prices over 7 and you divide it by 7 and it will give you a point on the moving average. And so the fast moving average, for example, is 7, will show it closer to the price than a slower moving average, such as 21 and such as a 200-day moving average. We use moving averages to help identify the past, the current, and potentially the future trends. The past is what we see occurred with the prices on a chart. The current is seeing where are we with the moving averages. So right now, the 7 is above the 21. The price is moving up. The price is above the 200-day moving average. So where is the market more likely to move? Future trend? Up. Swing crossovers. So here's the first trading strategy. I don't know what has happened over the last couple of years, but swing trading has been called something different than when I started. So in 2003 up until 2014, 15, swing trading was basically 2 moving averages or that have crossed and that you're going to constantly swing and buy a market and then sell a market and then buy and then sell and just swing your positions from long to short to long to short. And not just with moving averages, it can also be with one moving average where the price closes above the moving average, you go long, and if the price closes below the moving average, you go short. Anyway, it doesn't only apply to moving averages. It's just constantly being in the market and swinging from long to short. The swing crossovers, for example, with the 7 moving average and the 21 moving average, the buy signal is when the 7 moving average crosses above the 21 moving average, okay? And when the price confirms and opens above, that is where you go long. So you go long, you buy at this level, and you hold, and you wait for the market to cross over and confirm. So some people have a confirmed motion saying that if the line is touching the moving average, I'm going to remain in my position because it might be a short-term retraction or contraction and retracement, sorry, and then it's going to continue up, which it did. So you hold on to your position, it's touching the moving average. And by the way, this is one of the secrets that people don't tell you about of when do you switch to a short. So touches, you carry on holding, still looks good, then it crosses, okay, confirmed, it's actually broken apart. And some people make these moving averages a lot thinner to confirm. Others make it a lot thicker so that they will handle the sideways movement or the retracement before the market continues up. So they held on to this price at, dare I say, 145, or let's say 147. They held on, the market moved up. You can see this is a daily chart. And then when it crossed over, they got out at 195. In this case, it would be dollars. So they got out at 195, they got in at 147, they banked the profit, but you don't close the trade, you swing. So you shorted, at a certain price, you then obviously over here, you would have taken a loss because sideways motions do not work well with crossovers. And then over here, you went long again, the market moved up, and here you banked another profit. Here you probably would have banked a loss. You're also holding on to an extended period of time, and then the costs are starting to accumulate due to the interest costs that are added on. So it crossed below, down, you shorted, and you took a loss. So you took a loss here, you took a profit, you took a very nice profit here, you took a loss, and here you shorted it, and you took a major profit over here again. And you're just holding on, and there is no guessing. There is no gut feeling. You're just going with the strategy. What time period would you recommend for swing trading? I would recommend daily. Personality thing. I do know traders that are still using hourly charts and 30 minutes. It's a lot of work. If you do not want to be sitting in front of a screen and going back to the rat race, just taking trades every single day, based on conditions that you cannot control, I would also stick to daily. So daily is perfect for this type of swing trading. And also, I do not swing trade stocks, because being in a market in stocks, there is higher risk at liquidations, manipulation. Things can happen overnight. There can be a crash in the market. And the longer you're exposed inside a certain stock, there are higher chance that you will possibly be caught in the crossfire. So I love trading indices when it comes to swing crossovers. Do you use SMA or MA? SMA, as far as I know, is MA. Simple moving average is a moving average. A moving average is a simple moving average is clearly that. It is taking a certain amount of prices, dividing it by the number of periods that you've added on to those prices. Moving average might be a collection of different moving averages. So there's an exponential moving average, there's a VWAP moving average, there's a volume weighted moving average, there's exponential, I think I said that. So I choose SMA because it makes life a lot easier to understand. Let's move on. You have your buy signal, you have your sell signal, and then you have another style of swing trading, which is with a 200-day moving average, where you are always in the market and you are long and short, and you're using the most powerful moving average in the world, the 200-day moving average. And why is it the most powerful? Well, there are a few reasons, but I don't have the exact reasons. One is that there are possibly only 200 working days in a year, so it does make up for the 200 that are taking place within the working period. Two, there is confirmation bias, that people have just depended on this 200-day moving average. When the price moves up and people see it above the 200-day moving average, the self-confirmation or confirmation bias is that many other traders and billionaires and institutions and market makers and banks are seeing the exact same thing and are acting accordingly. So the 200-day moving average is the most powerful moving average in the whole of technical analysis and trading. So with swing trading, the 200-day moving average, you're also always in the market, long and short. You're swinging in, you're swinging out. You get in, you go long, you're waiting for your criteria for the candlesticks to confirm, close below. You're holding it, you're holding it. Then it closes below, you get out, you swing short. Here, you would have thought you were making an absolute killing. The market was crashing good 10, 20%. And then it just recovered straight too. And then you were saying, I should have gotten out. I should have banked my profit. The market was really right there. But you got to follow the strategy. And when you follow the strategy and you're following the rules, that's when you celebrate. You don't celebrate when you take a premature profit without following the strategy. In fact, you're punishing yourself, because trading is not a short-term thing. So don't worry about these little situations. I had it recently I sent out a Forex trade and it was just a few cents away from the take profit. And then it went and hit the stop loss. And I'm not worried. I've seen this a million times. It's part of the trading thing. As long as I didn't go against the strategy, I'm winning. Market closed up, you went long. And then there was this position where you got in, you went long, and you held it. And take a look at that. You would have made up for any loss that would have taken place over the whole year just because of this little trade where they followed the trend. And then here you would currently be going short You don't know if the situation will form again, so you just continue to hold the market. You're always in the market when you're swinging, and you're following using the 200-day moving average. Very nice strategy. Next we have is swing with the 50-day moving average. So if the 200-day moving average is too slow for you, you can use the 50-day moving average instead. But I warn you that there are going to be a lot more trades that you're going to be taking and a lot more disappointments when the market does start trading sideways. Also on Forex and indices for 200 SMA, yes, you do. You use the 200 SMA on pretty much any market and any stock, any cryptocurrency. What I can say is that sometimes certain stocks act differently with certain moving averages. So if you do decide to put a moving average onto a certain stock to follow, see which one fits that stock specifically. So 21 moving average I find is a really good moving average for stocks, and 7, because when 7 crosses above the 21, the trend is more likely moving up. When the 21 crosses below the 7, the trend is more likely to move down. Masterclass lesson 13, the relative strength index, or the RSI. So the RSI, the relative strength index, looks like this. It is used to measure the speed and change of price movements. It measures the strength of its trend direction up, down, and sideways on any market by monitoring the changes in its closing price. So what's important to note about the RSI, and we're now talking about the anatomy, is that it is a closed oscillator. And what I mean by a closed oscillator is that it has a limit between 0 and 100, and then stops right there. Right. So with the RSI between 70 and 100, we say that it is overbought. And overbought is basically where the market is at a certain price beyond high. The buyers are going to start fading out. So the market moves up, there's buying, and the demand is increasing. And then when it gets to the point where there's been so much buying, it forms a little bubble. So it forms a little bubble, and at the overbought levels, we can expect the price to then start dropping and for the sellers to start kicking in, which will drop the price. Between 70 and 100 is overbought, where there is a lot of supply and a lot of buyers that have bought into the market, and now the sellers want to take over. Then you have the oversold level, which is between 30 and 0, where you have the market that has been selling and the price has been going down. And now at a certain level, the buyers are going to say, hold on, the market is now quite low, and we are going to start buying the market to push it back up. So the overbought zone is where the X is above 70. And this gives a selling opportunity in a trending market that's moving up. And the oversold, which is the X is less than 30, is a buy opportunity for where the market has been coming down. All right. Notice I use the word trending market. Then we have the market environment, which is also very important. Now, the way I see it with RSI, not everyone sees it this way, but I like to use the 50 level of the RSI to determine whether the market is in a bullish momentum or in a bearish momentum. Between 50 and 100, when the RSI crosses above 50, it is in a bullish territory. This is where the buys are kicking in, okay? Then you have between 0 and 50, where I like to call it a bearish territory, where the sellers are still dominating the market and the price is more likely to continue down, or it is in a downtrend. In a trending momentum market, not sideways. Sideways, these indicators are null and void. I tell you that much. They do not work in sideways markets. It does not apply with a sideways trend ever. So the 50 mark is the neutral zone that you can determine where the price you wanted to break up for going into a bullish territory for the price to move up, or break below the 50 to enter into a bearish territory. So now let's talk about divergences, which is probably the most important element to RSI when trading a market. So the first thing, the two divergences that we're talking about is a bearish divergence and a bullish divergence. So the first one is, let's talk about a bearish divergence. A bearish divergence is where the price of the market is moving up and the RSI momentum is moving down. This tells you that the buying that is taking place within the price is not as strong and convincing, and therefore you can expect the price to drop. So this is what happens. The price moves up and the RSI drops. And how you use this is because you're using the resistance or the ceiling level that I explained earlier, where they are making lower high prices. And when it makes lower high prices, well, the price is making higher lows. Then basically it's saying that the momentum of the RSI is showing bearish divergence, where the price is now more likely to move down and break down, which it exactly did at this point. The RSI in this case formed a bullish divergence, and a bullish divergence is where it started forming higher low prices. Okay, so it formed higher low prices. Well, the market was making lower highs. Now this is known as a bullish divergence, where the price is coming down and the RSI momentum is going up. And this is an indication that the price is more likely to move up. We have the RSI indicator at the bottom and we have a price at the top. Where is the lowest low and what is the next low? This momentum is showing that the RSI is moving up in momentum. Then let's see what is going on here. So at this point, there's a low price, and at this point, there is a higher low. So what you can say is that there is a confirmation divergence, that there is bullishness in the market. So when the price of the RSI is moving up and the price of the market is moving up, there is a high chance that the momentum will continue, which is exactly what it did and looks good. When the price broke above the 50 mark, the upward momentum continued. And when the price broke below the 50 mark, the downward momentum continued. And now at this level, we can say that the market is overbought, but you do want to follow the trend and have other indicators in the background to help you confirm of where the market is more likely to go. Can we use the 4 moving averages simultaneously? Okay, so moving back to the moving averages. Yes, you can use them simultaneously. When the 7 moving average is above the 21, above the 50, above the 200-day, and they've all crossed up, then that could give a great confirmation signal that you can go long. The problem with using 4 moving averages is that for the 200-day moving average to cross below and for that to be your signal to sell again could be too late. You could have missed the entire movement of the trend. So I use less moving averages when it comes to trading strategies, because the more moving averages, the more you have to wait. And the best price of indication of a trend changing is 2 things: your eyes and the price action. So if you're waiting for a 200-day moving average to cross, you would have missed out. Would the volume be weak on bullish and bearish divergence? Yes. Right, but we are entering into a completely different trading strategy called VSA. Volume spread analysis is another completely different analysis based on volume. When volume's going up and price is going up, there's confirmation. When the price is going down, the volume's going up, there's confirmation of a trend. There are many different ways, but look up volume spread analysis. Tom Williams has a brilliant book on it, and you can. Does the RSI have a time period? I use 18, but you can use 20. 20 and 18 are very similar. You can go into the settings. Sometimes there is a moving average placed on the RSI. I think it's too cluttered. I also like to remove the moving average. I want my charts to be clean and visible. I also make the RSI, instead of blue, for example, I make it black so I can see exactly the difference between overbought and oversold, and in between the 50. So it's all based on visual appearance with how you like the RSI. You will see that here is the RSI summary in 3 trading signals. Sorry, the overbought trend lines, the bullish and bearish. These are all different types of trading signals that you can watch out for with the RSI. Masterclass lesson 14, price action candlesticks charting. The 24 most popular candlestick formations. So now I know a book that a Japanese guy wrote. I forgot what it's called. I think the book is called Candlesticks, and it's like hundreds and hundreds of pages. And it explains these few candlesticks with such jargon, and it's laborious, and it just goes on and on and on. And I'm reading it, and I'm like, maybe I'll gain extra information that no one else will ever know. And nope, it's just explaining and going around in circles. So I want to explain to you the 24 most powerful candle chart patterns that I've ever seen in bullish versus bearish. I'm sure that will help. This is one of the reasons that you're here today, is to learn these candlesticks for once and for all. So let's look at the first candlestick pattern. Remember in the beginning when I explained the basics of candlesticks, there was a reason I did that, and that is so that I can now explain the formations of the candlesticks. The first one is bullish engulfing. The bullish engulfing is where the green candle engulfs or eats away the previous candle's movement. So in this case, there is a small down candle, and then it made this bullish engulfing candle, ate the small one, and basically is saying, nope, we're not going down, we are going up. That is a strong bullish candle. You then have the opposite, which is a bearish engulfing, where you have this big bearish engulfing candle eating the little up candle. Momentum is not going up. We are going down. We are taking over. The sellers are going to win. Let's go, guys. Down we go. So that's the difference between a bullish engulfing and a bearish engulfing. After this, you'll never forget these candle patterns the way I'm explaining. Then you have the bullish marubozu. Sounds Zulu. It's Japanese. So the bullish marubozu. And this is like an engulfing candle, but the difference is that there are no wicks. So there's no wicks. It is just a complete body of a candle, of an up candle, where the open price is equal to the low and the closing price is equal to the high, and there are no wicks. So that's the bullish marubozu formation. Then you have the bearish marubozu, where the open price is equal to the high price and the closing price is equal to the low price. And it's basically saying that the bears are winning, the sellers are winning, and the market is more likely to head down. Then we have a bullish hammer, which are very common, and very seldom you can make confirmation decisions on whether you're going to buy or sell. But anyway, here it is. A bullish hammer is where the open price is equal to the high price is equal to the closed price, and it forms some type of hammer, but saying that the buyers won this candle in this case. And obviously the opposite would be a bearish hammer, where the open price is equal to the high price and there is a closing price of the candle, and in between, so there is a small body and a huge wick, and it looks like a hammer. It's as simple as that. So there is a bullish and bearish, bullish hammer and bearish hammer candlestick formation. We then have the bullish pin bars. And the bullish pin bars is where there are two pretty much identical twins of candles that has formed first the down candle between the open and close, and then the next candle where we have the open and close, and basically they cancel each other out, and it's saying that we are not going down, we are going up. So that's the bullish pin bar. And opposite, we have the bearish pin bar, where not only is it between where the open and close is for the down candle and up candle, but it's also with how big the wick is. So in this case, you can see that the bears won where the candle closed, but the up candle, you can see that the market went down to test that level, failed to break below, closed above, and is showing bullishness to come. Similar with the bearish pin bar, where it formed a bearish candle, the up candle went up, failed to confirm, went back down, and closed above the close. So once again, these are not confirmation candles. These are just names of the candles that you can use. Bullish harami. So the bullish harami and the bearish harami. Harami, as far as I know, means pregnant. And the bullish harami is basically saying that there is a mother candle. There is a mother candle who's a down candle, and it has just given birth to a baby up candle. That's how I can explain it. So the bullish harami with the bearish candle, where the mother has given birth to the baby candle, and the baby candle is in between the mother's body. So that's how you can establish of between a bullish harami. Then we have the bearish harami, where the mother is an up candle, and it is quite a large candle, and it's given birth to a baby down candle, which is it confirming that there's downside to come? Like I said, do not use individual candles for confirmation. Use other indicators, use momentum, use trend lines, and then take a look and say, all right, boom, there's a bearish harami. How is it looking in relation to other indicators? The bullish spinning top and the bearish spinning top. So the open is below the closing price for the up candle, but you can see that it looks like a spinning top. The wick between the high and the closing price is very similar to the wick between the open price and the low. Similar to the bearish spinning top, the open has quite a large wick between the high and the open and the close and the low. So bullish spinning top and bearish spinning top. Dragonfly doji. This is one of the most bullish candlestick charts that you can get when it comes to trading. And basically it's saying that the price opened at a certain level. Then there was testing and supply where the sellers brought down the price to a certain low, and then it went right back up to the high where it opened, and it closed exactly where the high and the open is. This is a dragonfly doji. It's bullish, and it's a good signal sometimes for reversal in a trend. You then have the gravestone doji, which is the opposite, where the price opened at a level, the market moved up to a certain high, it went right back down, and it closed at the low, which is also where the open is, and it formed a gravestone doji, which can also indicate a reversal of a trend. So if the market's moving up and then you see a gravestone doji, watch out, because we can see a potential change in the trend in the markets. Then we have a hammer and we have a hanging man. So a hammer is now in relation to quite a few candles where the market's coming down at a certain rate, and then a hammer forms, which, as I explained to you earlier, there was a bullish hammer and bearish hammer. In this case, it's a bullish hammer, which indicates that the price was testing the selling, was testing the supply, and then the market moved up, and it closed at the high price, which means that there can be upside to come. Now, these type of candle patterns are amazing for intraday traders if you're looking to trade price action and how candles work. It's also amazing for confirmation for when you are, for example, looking at chart patterns, and a chart pattern forms and then you see a hammer, which is either confirming a reversal or a potential continuation of a trend. You then have a bearish hanging man, so it's the opposite of a hammer, which basically signals that there is downside to come. The hammer formed, and after the upside trend, it has now formed a hanging man where you can expect downside to come, but always use confirmation indicators to help with your analysis. Then you have a morning star doji. Now, a morning star doji is the price is coming down, and then it forms this doji out of nowhere, where the open price is equal to the closing price. There was testing in the low, there was testing in the high, and this is quite a bullish candle where you can now expect the price to continue up. Similar to an evening doji star, which I find even stronger than a morning doji star, where you can see there is upward momentum, upward trend. It then forms this evening doji star where the open is equal to the close, and there is a form between the low and the high, which can indicate that there will be a reversal in the trend. You then have a morning star, which is very similar to the doji, except there is a little bit of a body. So the morning star, you can see it forms a type of spinning top in a way, but a bullish spinning top. And after a downside in the market, there is a morning star, which should give you morning glory. Did I just say that? It should give you upside momentum for the candles. You then have the evening star, which is the opposite of the morning star, where it forms right at the top of all the candles, and there is bearishness and downside to come, and it indicates that there is a change in the trend. Then we have the piercing line and the dark cloud cover. These are awesome terms, by the way. Piercing line, dark cloud cover. And yet they are the most laborious and boring candlestick patterns in the whole of candlestick charting. But anyway, a piercing line is where there is a down candle, and next to that is a green candle, and where the open price of the up candle is lower than the closing price of the down candle, and the closing price of the up candle is lower than the open price of the down candle. vice versa with the dark cloud cover, where the open price is lower than the closing price for the down candle, and the open price is lower than the open price for the down candle. So that's a dark cloud cover. Not very cool, quite a boring candlestick formation. I wouldn't do anything with it, to be honest. Then you have the three white soldiers. Now, this is my favorite candlestick pattern formation. Watch out for them. They are coming. The three white soldiers shows you three consecutive grand up candles next to each other with great momentum to show that there is upside to come. These are excellent candles to identify reversal in a trend. The opposite are the three black crows. So the three black crows are showing you three consecutive red candles in whatever trend was happening in the previous, whether it was going up or down. These three black crows indicates that there is downside to come. It's bearish, and you got to watch out for them. So the three white soldiers and the three black crows. Those are 24 candlestick patterns that you need to know. That's the end of that. Masterclass lesson 15, range bounded buy and sell in between ranges. So you have a range bound setup where there must have at least 3 touches on the support and resistance line before it is considered a valid setup. So the more price touches that there are in the resistance and the support, the more validity this setup is for this type of trader. So you can see that there are 3 lows and there are 3 highs, which establishes that there is some buying activity and selling activity that can take place for a range-bound trader. So let's take a look at what we mean by that. And basically, these range-bound traders look for sideways consolidation box formations where they can trade in between the range, between certain lows and highs. They buy low, they sell high, they buy low, they sell high, they buy low, they sell high. Market breaks above, they wait for the range to confirm. And then once that happens with 3 touches, let's say those are 3 touches, they buy low, they sell high, they buy low, or in this case, they probably would have made a loss. They sold high, they bought low, they sold high. And this is how they do it. So here's an example with the Japanese index or the Nikkei 225. It's a great index to trade range bounded out of majority of indexes that I've seen or indices that I've seen. And I do know traders that like trading the Nikkei 225. I'm not an expert in range-bounded trading, so I cannot tell you exactly the statistics and how it works. For me, it's very boring to wait for sideways motions and then just to trade the lows and the highs, because there's only so much that you can go up, and compared to with trend trading or breakout trading, where you can just follow the trends and you can just carry on letting your gains continue up. Range bounded, unfortunately, there is a limit. And there are breakouts from those that there are many fake outs. So I don't have a lot of experience with range bounded. I just have an idea of how they go about it. Masterclass lesson 16, explained breakout trading. So here's an example of a chart with a bunch of breakout patterns. Now, what is breakout trading? Breakout trading is a strategy where a trader identifies a pattern, then buys or sells the market when the price breaks up or below a specified support or resistance in order to ride the continuous or reversal trend for a profit. Let's go back. Let's say that again slowly with images. So, breakout trading is a strategy where a trader identifies a pattern, can be any pattern, and then buys or sells the market when the price breaks up and out of that pattern or below a certain pattern at a specified or a chosen support or resistance level in order to ride the continuous trend or reversal trend for a profit. So let's do this in 2 ways. There are 3 steps with breakout trading. First is the wait. You wait for the pattern to form. The second is the break. You wait for the breakout with the market. And the third step is the trade. Once the price opens above the breakout level, just take the trade. JTTT, just take the trade. I'm going to put that on. I'm going to give it to you for free because most of you are not taking the trade. So just take the trade. Masterclass lesson 17, 3 steps to enter your breakout trade. Let's look at it with candlesticks. So step 1 is the wait. You wait for a chart pattern to form, in this case, a box formation. Step 2 is the break. Break is you wait for the breakout above the formation. Step 3 is the trade. JTTT, just take the trade. When the breakout has confirmed, that's your trade signal. That is where you get in. The open of it, you get in. And if you miss the open and the market continues up or down, just take the trade and change your stop loss and take profit according to your risk to reward levels. And step 4, the most important, once you've taken the trade, is leave it alone. Let the market take over. Once you've put in your entry and your exit levels, let the market take over. What indicator takes preference between moving average and RSI, or do you have them to align to trigger? I don't know if you're part of the premium multi-trader service, but if you are, you would know, or if you're not, or if you are, it doesn't matter. But the thing is, what I do is I put in all my moving averages. So 7 moving average, 21 moving average, the chart patterns price breakout using candles, and then the RSI with the 18 or 20. And I align them all together. And the RSI tells me the momentum and the confirmation of where the market is more likely to go. The moving averages also gives me an indication of where the trend is going. But I do not use the moving averages and the RSI for confirmation, as in for the execution for taking the trade. I just use it for peripheral. The RSI, the moving averages, if you want to put a stochastics or a MACD or the Bollinger Bands or the volume weighted average, whatever you want, I use it for peripheral. What I only use for execution is for the price to form a chart pattern, to break out. That's where I get in, regardless of anything else. International and local stocks, I use daily for indices. I use daily for commodities. I use 4-hour for Forex, and I use daily for cryptocurrencies. But mainly only Forex is where I drop my time frame to 4 hours. But sometimes I do use daily. It all depends on where the chart pattern is lining up. How do you calculate the take profit point and the stop loss point? Good question. I'm going to save that for a little bit later when I explain chart patterns, if that's okay. Masterclass lesson 18, 24 breakout chart patterns explained, revealed, all here, ready for you. Normally, I only reveal 5. Let's start off similar to what we did with candlesticks, and now let's look at chart patterns. So the first one is the ascending triangle. So I am going to probably go through this alphabetical order so that we can go through all the chart patterns. The ascending triangle is where the price of the market makes higher lows and same highs, which then converges to an apex, and then we wait for a breakout. And then you determine where the stop loss and take profit is. So where I put my stop loss and take profit is always above more than 1 to 1. So 1.5, so 1 to 1.5 is my risk to reward ratio. Or when the market is trending and is doing well for us, the risk to reward is 1 to 2, which means I'm willing to risk 1 to make twice as much. So with the ascending triangle, once the price breaks up and out of the resistance, I get in and I set my stop loss pretty much halfway between the formation, sometimes below it, sometimes below the whole formation. And then I set my take profit twice as much as where I put my stop loss. There is no magic level where to put your take profit level. Some people use Fibonacci's, others use regression, others use Elliott waves. It's all changing chaos into order. It's all within your own confirmation bias, nothing else, okay? There are no magic indicators. So it's as simple as the risk to reward of 1 to 2 or 1 to 1.5. So the ascending triangle was the ascending triangle was the first formation, and the opposite is a descending triangle where the price forms lower highs and it bounces on the same lows. Then the price of that pattern breaks below the support, and that's where you expect the market to continue down. And so you set your take profit twice as low as where you are willing to set your stop loss. That's the difference between an ascending triangle where it's ascending and a descending triangle where the price is moving down. Then you have a cup and handle, which is my favorite formation, which basically shows you a big rounding bottom and a small rounding bottom, which forms the handle, and a big rounding bottom that forms the cup. The price then breaks above, and I normally set my stop loss just below the bottom of the handle, and I set my take profit twice as high as where the risk is. So that's the cup and handle formation. Then you have an inverse cup and handle, where it's basically the opposite of a cup and handle. You're turning the cup and handle upside down, where it forms a big rounding top, which is the cup, and a small rounding top, which is the handle. And then the price breaks below the support of the cup, which is also known as the brim level. And then you set your take profit twice as low as where you would set your stop loss or your risk. So in this case, you would put your stop loss just above the handle, and you would set your stop loss, your take profit level twice as low. Okay, so bullish formation of a cup and handle formation, you're waiting for the cup and the handle to form, break out, and then you follow in the direction of the trend. And the inverse cup and handle is you wait for a rounding top, which is the cup, and a rounding bottom, small rounding top, which is the handle, break below, and then you're going to follow the direction down. Then we have the double bottom, which is also known as the W formation. And basically this is a formation where there's two rounding bottoms. The price breaks up and out of a resistance level or a neckline. In this case, we call this a neckline. And then we follow the direction of the trend, and we set our stop loss 50% of the W formation. You then have the bearish formation, which is a double top, or the M formation, which forms two rounding tops. You wait for the price to break below the neckline, and then you will hold on to your trade as you expect the price to drop, and you will set your stop loss 50% in between the head of the top double top and the bottom of the double top. Then we have a falling flag. Now, a falling flag is where the market has been moving in an upward direction and it has a flagpole. Then the price moves in between a range, and that range forms what looks like a flag, not a pennant, not a triangle, but an actual little flag. And then we wait for the price to break up and out of the flag formation. We set the stop loss just below the bottom of the flag formation. So I like to give it some leeway. And then I set the take profit twice as high as compared to the where the stop loss is. So that's the falling flag. So the flagpole raises up, the price forms a falling flag, the price breaks above the falling flag, and then we ride it on up and take profits. The bearish is the rising flag. The rising flag is where there is a downward trend line. It then forms a rising flag with the price. We then wait for the breakout below the rising flag, and then we expect the price to continue down, as this is what you can think of as almost a small recovery within the bigger downtrend. So when there is a small recovery within the bigger downtrend, we expect the price to break below and continue down. And we, as always, we set our stop loss just above the formation so that we can give leeway in case the market does test these levels. So that's the difference between falling flag and a rising flag. We then have the falling pennant and the rising pennant. The falling pennant is very similar to the falling flag, okay? But the trend is moving up, and instead of forming a flag formation, it forms somewhat a wedge pattern, but it's also known as a pennant formation. Now, a pennant compared to a wedge is a lot shorter direction, shorter duration. When you think of a pennant, think of a short duration movement within an uptrend. So with a falling pennant, you expect the price to move down, and then once it reaches 3/4 of the apex, it will break above the falling pennant, and you expect the price to move up, okay? And then you can set your stop loss just below the bottom of the pennant, or give a little bit of leeway so that you can give the price to move around. Then you have the rising pennant, where you have a downtrend. The price then moves in a triangular formation up, and it forms a pennant formation, and then the price breaks below the rising pennant. Once that happens, you've got your levels. You've got your entry, which is immediately the open price of the candle that opened below the rising pennant. You have the stop loss, where you're putting leeway for if the price does decide to move up again. And then you've got the take profit, where the price will continue down and you will bank your profit. Then we have the falling wedge and the rising wedge. The falling wedge is a lot bigger than a pennant. So it looks like a pennant, it acts like a pennant, except there are a lot more candles. So a falling wedge is where the direction has been moving up in an uptrend. It then has a retracement of around 1 to 2 to 3 months of movement. Notice 1 to 2 to 3 months of movement within a wedge formation. The price then breaks up and out of the wedge formation, and you hold it because you expect the price to move up, and then you set your stop loss below the wedge formation to give it leeway. The rising wedge is the opposite of a falling wedge. It's when the price of the market has been coming down. You expect the price of the market to form a rising wedge. Once the market breaks below the rising wedge, that's where you get in. You set your stop loss above the rising wedge, and then you set your take profit twice as much of what you're willing to risk. Inverse head and shoulders. So the inverse head and shoulders is a bullish formation where it forms a small rounding bottom, which is known as the left shoulder, a big rounding bottom, which is the head, and a small rounding bottom, which is the right shoulder. It then forms, the price goes up and down until it hits a neckline. The price breaks above the neckline, where you go long or you buy, and you set your stop loss below the bottom of the right shoulder. So you set your stop loss below the bottom of the right shoulder, and then you ride it on up until it hits the take profit. The opposite of an inverse head and shoulders is a head and shoulders, where it forms a rounding top, a bigger rounding top, and a smaller rounding top again. So the left shoulder, the head, and the right shoulder, the price breaks below the neckline, you hold it, you set your stop loss above the top of the right shoulder. You set the take profit at about 2 times more than what you're willing to risk at around this level, and Bob's your uncle. The rectangle formation, bullish. So we've already done this before. You wait for the price to form in a rectangle formation. The price breaks above the resistance where you get in. You set your stop loss, sometimes 50% of the rectangle formation. If it's a small rectangle formation, then set your stop loss below the entire formation, but make sure the take profit is twice as much of what you're willing to risk. The opposite is a rectangle formation, but bearish. So what I call this is a bearish box formation sometimes. The price forms a box formation, and instead of breaking up, it breaks down. You set your stop loss at 50% of the height of the box formation or above the box formation resistance, and you set your take profit twice as much that you're willing to risk. Then we have a simple rounding bottom. Now, this is pretty much one of the easiest formations you see, but also quite common. So you see a big rounding bottom form. There is a neckline. The price breaks above the rounding bottom. That's where you hold it. You set your stop loss about 50% of the height or below the rounding bottom, depending on what you want to do. And then the rounding top is the opposite, where it forms a rounding top formation. It then has a stop loss 50% of the height, and then you set your take profit way below, about 2 times of what you're willing to risk. Symmetrical triangle. Now, a symmetrical triangle is similar to a wedge, is similar to a pennant, except this is where the triangle pretty much is symmetrical, believe it or not. So it moves in a sideways formation, and instead of converging on a downtrend or an uptrend, it converges sideways. And then you're waiting for the price to break up, and out of the symmetrical triangle, this is bullish. Then you set your stop loss just below the symmetrical triangle. You set your take profit way above 2 times or whatever you're willing to risk. Make sure it's a little bit more. And the opposite we have is a symmetrical triangle bearish. And this is where the price is coming down. It forms a symmetrical triangle. It breaks below. You set your take profit twice as much as what you're willing to risk. So I like to set my stop loss just above the resistance of the symmetrical triangle, so that we're giving it leeway and we're preventing fake outs. We always want to prevent fake outs with trading, and we do this through experience. So that's a symmetrical triangle. Triple bottom is like a double bottom or a W formation, but it has 3 rounding bottoms. As you can see, it has a neckline, and you wait for the price to break above the neckline. You then hold on. You set your stop loss 50% of the height or below it, depending on what you want. The opposite is a triple top. A triple top, it looks like a head and shoulders formation, except the rounding top is at the same height as the head, is at the same height as the right shoulder. So the triple top looks like this. You wait for the price to break below. You set your stop loss 50% of the height, or you set the stop loss above the formation itself, and you make sure that the take profit is 2 times of what you're willing to risk. And I think we are coming to the end with the broadening bottom, or what I call a vuvuzela formation. If you've been with me since 2013, you would know exactly what I'm talking about. So broadening bottom is where the price broadens and forms a triangle formation, but broadens from the beginning of the formation to the end, and then it breaks out of the broadening formation. I like to set the stop loss below the entire broadening formation and the take profit 2 times higher. And then we have a broadening top, which looks more like a vuvuzela, where the price forms a broadening formation where the price hits higher highs and higher lows, or it kind of depends. This is more of a subjective type of formation that you can see when it's converging out, and it forms a broadening top formation. And then you can set your stop loss either 50% of the broadening formation, above the broadening formation. But the most important thing is to set your take profit twice as much as what you're willing to risk. There's so much talking lately on hyperinflation. Is it to be concerned? The first thing is that prices are going to go sky high. So people are not going to be spending as much. And what they're going to be doing is they're going to be putting their money and depositing it into the bank when interest rate starts going up to curb inflation. When this happens, people are going to be getting out of shares, out of commodities, out of safe havens. They're going to be going straight back into the bank, and then the markets are going to crash. Simple. So inflation does not have a good effect on markets. But then it gets to the point where the crash invites more buyers when the prices have dropped to such an extent and the PE ratios have dropped to equilibrium levels again. which is basically how a bubble works. And then that buying sensation that takes place, which I absolutely look forward to, goes to the point where you make up for all of the losses during the downward periods. I hope that helps. Goodbye, goodbye, and goodbyes.